The largest pizza company on earth has lost nearly a third of its value in a single year. Its shares sit in the bottom fifth of their range, marked down hard by a market that clearly senses something wrong. Is this a rare bargain or a business quietly breaking? Revenue is still climbing, earnings per share are still growing, and yet the stock keeps falling. The puzzle is where that growth comes from, the cheapest, thinnest part of the whole machine. So has the market punished a stalling business too far or not far enough? By the end, you will understand what Domino's actually earns, how it turns pizza into cash, and where that cash goes. You will see why a company with negative equity can still compound, what its valuation now implies, and the one number that would flip the thesis. Domino's looks like a restaurant chain, but that label misleads. Roughly 21,000 stores, almost entirely franchised, sell the pizza. The money crossing its own income statement mostly comes from selling flour, cheese, sauce, and equipment to those franchisees. It is a royalty engine bolted to a food logistics wholesaler. The revenue split makes the model plain. Of nearly $5 billion, supply chain shipped $3 billion, about 60%, dough and cheese trucked to stores. Domestic stores added roughly $1.6 billion, and international franchise just $300 million. Size and value are not the same thing here. That tiny international sliver is almost pure royalty. Domino's takes a cut of sales without buying a single ingredient or running a store. The giant supply chain line is high volume, low margin distribution, so the fastest growing reported number is also the least valuable. That is the tension. The top line has been pedestrian. Revenue crept from $4.4 billion in 2021 to $4.9 billion in 2025, compounding just 3.2% a year. For a stock the market once treated as a growth compounder, that is a slow, lumpy climb. Earnings per share tell a flattering story. Diluted earnings climbed from $12.53 in the trough year to $17.57 in 2025, and the trailing figure sits near $17.63. That is double-digit growth on low single-digit revenue. How? Margins hold part of the answer. Gross margin bottomed at 36.3% in 2022, when commodity inflation crushed the supply chain spread, then recovered above 40%. But that was a rebound off a cyclical low, not fresh pricing power. The tailwind is largely spent. Here is the strongest number in the picture. Return on invested capital has held between 52 and 57% for 5 straight years, reaching 56.7% in 2025. Against a high single-digit cost of capital, that is an enormous and remarkably stable spread. That royalty machine sits on a heavily engineered balance sheet. Net debt runs near $5 billion, and net debt to EBITDA has hovered between 4.5 and 6 times. This is securitized franchise debt, borrowed against predictable royalties. Deliberate, not distress, but it leaves little cushion if royalties shrink. Cash generation is genuine, and it backs the earnings. Free cash flow reached $671 million in 2025, and about $653 million trailing. On capital expenditure, barely $120 million, under 2.5% of revenue funds all the growth. Domino's is a return of capital machine. In 2025, it spent $358 million on buybacks, and the trailing pace has quickened past $400 million. Franchisees fund the stores, so almost all the free cash flow flows straight back to shareholders. Those buybacks shrank the share count by roughly 9% over 5 years. That steady reduction is the main reason earnings per share outran net income. There is a catch, though. Much of the heaviest buying happened in 2021, when the stock traded above 40 times earnings. The dividend earns real credit. Payout per share climbed from $3.75 in 2021 to $6.97 in 2025, with the trailing rate at 7.46, compounding near 16% a year. It takes only about 40% of earnings, leaving ample room to keep rising. Why do returns like that persist? Scale mostly. Domino's mills its own dough and trucks ingredients at a per-unit cost no independent shop can match, and it pockets the distribution margin. Layer on a decade-old digital platform carrying most orders and a loyalty program, and switching gets sticky. The counter-evidence is real, though. Flat domestic comps and negative international ones say the moat guards profitability far better than it guards growth. Burger and burrito chains are winning the trade-down dollar, and pizza is faring worse than some rivals. A moat around margins is not a moat around customers. Still ahead, what the shares are worth, and the single number that would break the case. First, the backdrop, and it is unkind. US fast food traffic has fallen for months. A spending index dropped about 4% by July, and consumers are trading down to value menus. With a beta near 1, Domino's is no defensive haven. Its delivery and carry-out model sits squarely in the discretionary crosshairs. Sentiment has turned hard. The shares trade near $326, only about 15% above their 52-week low and a third below the high. What could shift the mood? A leadership handover, for one. Joe Jordan takes the chief executive seat on the 1st of October. The real structural catalyst remains unit growth and any re-acceleration in same-store sales. The China stake write-down of $30 million is noise, not a signal. Domino's is a near-ideal candidate for a discounted cash flow model. Predictable cash, tiny capital needs, stable margins. Grow free cash flow around 6%, fade to 3% terminal, discount near 8%, subtract the net debt, and equity value lands between roughly $300 and $365. The earnings multiple says the same from another angle. Domino's once commanded 25 to 40 times earnings. Today it trades near 18.7. Apply a humbled but still quality 18 to 21 times to next year's expected earnings, and fair value runs from about $343 to $400. Because nearly all the cash returns to owners, shareholder yield is a fair test. Free cash flow of $653 million against the market value is a 6% yield. A franchise this stable would reasonably trade near a 5%, implying an equity value around $350 to $385. Blend the three, the discounted cash flow weighted heaviest, then the yield model, then the multiple, and fair value settles between about $320 and $375, centered near $347. Against today's $326, the stock sits modestly below the midpoint. Wall Street is not asking for heroics. Consensus sees revenue reaching $5.2 billion next year and earnings per share of $19.07, rising toward $22.42 by 2028, about 9% annual growth. Today's price needs Domino's only to meet that, not beat it. What would actually break this? The gravest threat is flat same-store sales hardening into structural decline. It shows first in domestic comps, then bleeds into supply chain volumes and royalties. The trigger to watch is clear. Comps breaking below negative 1% and holding while unit growth stalls. The leverage sharpens every blow, with little balance sheet slack. A deep recession that knocked EBITDA down 15 to 20% would tighten coverage fast and force a choice. The buyback dies first, and with it, the earnings per share lever. Watch interest coverage slipping below 4 times. The playbook may be tapped out too. Stuffed crust, aggregator delivery, and loyalty are all already in the numbers. Yet the upside is real. If the consumer pullback proves cyclical and comps re-accelerate toward 3%, the high-margin royalties inflate faster, and 18 times earnings looks far too cheap. So, bargain or breaking business? On the evidence, Domino's looks fairly valued, with a modest tilt toward cheap. The market already inflicted the D-rating a stalling business deserved, yet the franchise still earns above 50% on capital and returns nearly all its cash. What is priced in is stalled volume, not broken quality. This is an educational analysis, not investment advice. The numbers come from public filings and consensus estimates that can change without warning. Do your own research and weigh your own risk before making any decision. If this breakdown sharpened how you see the stock, subscribe. It genuinely helps. And tell us in the comments which company we should analyse next. Thank you very much for watching, and we'll see you next time.